following is a paid program. The opinions expressed are not necessarily those of WNBU and Interbanks Media. Welcome to All Things Money with David Blain, a thoughtful and revealing discussion of actionable ideas and effective strategies to help you through the complex world of investing, taxes, and real estate. Now, with All Things Money, here's David Blain.
Hello and welcome to All Things Money. I'm your host for the show, David Blain. Thank you for joining us today. We're broadcasting on 94.1 FM, WNBU, as well as cable TV 10 in New Bern. Also have the show on our website, www.dlblain.com. You can listen to this week's show as well as archive copies from the past couple of years. There's a form on the website to contact us if you have comments or questions about the show, ideas, topics you'd like to hear. Fill it out, send us a note, let us know what you're thinking. You can also contact us directly by email at allthingsmoney@dlblain.com. And of course, you can always use the regular phone, 252-633-0107. In today's technological age, we still like to pick up the phone and hear from people. So I hope you do too as well. Feel free to give us a call. We've got a couple of great topics for today. Talk a little bit about diversification and what we want it to accomplish, as well as talk a little bit about projected returns, what types of returns you should expect going forward from different asset classes, the stock market, bond market, that sort of thing. So to start off, we want to talk about diversification. Diversification in investing means splitting your assets amongst different types of investments that will hopefully go up at different times so that you have a much smoother ride. Last week we talked a little bit about one of the reasons that the ultra-wealthy end up falling out of being the ultra-wealthy, and they sort of have these booms and busts. And one of the big reasons is over-concentration. They tend to have the majority of their money in, say, one company stock or something to that effect. For the average individual, actually for the majority of individuals, trying to select individual securities is not going to be a successful way to accumulate wealth over the long term. In fact, if we look at 2008, if we go back to 2008, and this is why, is that you can go along for a number of years, and then 1 year can simply decimate someone's portfolio. If we go back to 2008, we see that about 25% of the stocks in the United States lost at least 75% of their value in 2008. Now I realize that some of those have since recovered. Most of them will never recover back from a 75% decline. The math is just too great. Now, if we look at the other side, I don't have the statistics here for everything, but I do have the statistics for the 6,600 mutual funds that are tracked by Morningstar. Morningstar is a big investment information provider. They track mutual funds, they track stocks, ETFs, and they provide some of that information for free and some of it for subscription. But anyway, they track 6,600 mutual funds, and only four of them lost more than 75% in 2008. Hey, 4 out of 6,600, I mean, that's not even a percent. That doesn't even register. Whereas if you were investing in individual stocks, fully 1 out of 4 lost 75% in 2008. So that illustrates the concept of diversification. Mutual funds generally own, 50 to 5,000 stocks, some of the bigger index mutual funds. And so that's what I'm talking about, diversification. You also have diversification between asset classes, meaning you have some money in stock, you have some money in real estate, you have some money in bonds, you maybe have some money in gold, that type of diversification across different types of investments. And one of the things that has been called into question the past several years is, does diversification work? And the answer is emphatically yes. What does not work is thinking, well, I have a large U.S. mutual fund. Well, I have 5 large U.S. mutual funds. I have 3 U.S. small mutual funds. I have 3 foreign mutual funds, and I have an emerging market mutual fund thrown in for good measure. Therefore, I'm diversified. Yes, you're diversified. You have literally tens of thousands of companies in your portfolio, but they are all stocks. And so you have effectively concentrated your whole portfolio and are accepting fully the amount of risk of the stock market. So yes, you're diversified within the stock portion of investing, but you're certainly nowhere near diversified outside of that. One of the things that we do when we look at investors and clients that come in is we try to ascertain their tolerance for risk. What is the threshold of pain, so to speak, that they can tolerate from the decline of their portfolio? One of the more important equations that we also evaluate is what we call risk capacity. And the risk capacity is an objective evaluation of how much risk that they can take. So the person may not think they want to take a lot of risk, but in reality, if they're young, they have a stable job, maybe they have, they're going to inherit millions from their parents, they have no dependents, something like that, they have a huge capacity for risk. We see this sometimes with older retirees that come in and they have, say they were a high earning couple and the husband and the wife both get, say $30,000 a year from Social Security, and then maybe the husband or wife has another pension and they bring in another 40. It's very common to see what I would call middle class Americans come in with retirement income of $75,000, $100,000 a year in guaranteed income from the government or a company. And then on the side they have, a $2 million portfolio. Well, literally, and their houses are paid off, their cars are paid off, they have no kids in college. Their capacity to assume risk is very large. That they could live on the guaranteed income that they have virtually forever and never touch their portfolio. And so a lot of them desire to leave it to their children. And so we encourage them to not go crazy with risk, but take some risk in that portfolio, that they're not going to spend all that money. There's no reason not to try to accumulate wealth for future generations. The same thing with younger people. Human capital, meaning the ability of a person to earn income, is a huge asset. In fact, it's the largest asset that any person will ever have. Even, Bill Gates, he didn't start off owning, 51% of Microsoft or whatever he owns. It was his human capital, it was his intelligence, it was that potential that he developed into software, into a company. The same thing with Steve Jobs at Apple. A lot of these people, it was that human capital that they actually transitioned and transformed into dollars. They didn't start out being the owner. Well, we're coming up on our first break. When we come back, we'll continue this discussion about diversification and risk. So for All Things Money, I'm your host, David Blain.